All right, so you want to figure out what a company is actually worth. What's the first tool you reach for? I bet for a lot of people it's a valuation multiple, right? You know, like the famous price-to-earnings ratio? It seems so simple, a quick shortcut to a really complex answer. But what if that shortcut is actually leading you straight into a trap?
Okay, let's just dive right in with a real-world question. You're looking at a company, and you need to know, is this a good deal or not? That's the exact question a team of managers at a packaged foods company, we'll just call them Company A, were asking themselves.
So they looked at this chart, right, and their price-to-earnings multiple, their PE, was just 7.3. Now you look at their competitors, the median was 14.1. Whoa, that's almost a 50% discount. So their conclusion was pretty much instant. The market just doesn't get us. Our company is an absolute steal.
But they were dangerously wrong. They hadn't stumbled upon some hidden gem. They had completely misread the signals. That simple PE ratio was hiding a much more complicated truth.
So how can a standard metric like that be so misleading? We're about to break down exactly what went wrong. And more importantly, we're going to build a framework to make sure we don't fall into the very same valuation shortcut trap.
You know, if those managers had just looked one column over on their chart, they would have seen a completely different picture. Using a more revealing multiple, enterprise value to EBITDA, Company A was trading at 11.7, and its peers, a median of 11.0. All of a sudden, that massive 50% discount, it's just gone. They weren't a bargain at all. They were valued just like everybody else. So, why the huge difference?
Well, the whole secret is in something called capital structure. It's pretty simple, really. Company A just had way more debt than its competitors. See, a PE ratio only looks at the equity part of the business. But all that debt, it ramps up the risk for shareholders, and that pushes the PE multiple down. So it wasn't cheap because it was a great performer. It just looks cheap because of how it was financed.
Okay, this whole cautionary tale really teaches us a crucial lesson. Using multiples isn't a simple plug-and-play game. It requires some serious analysis. So to avoid these kinds of mistakes, let's walk through 5 guiding principles for using them the right way. This is the framework that separates a wild guess from a real, solid valuation.
All right, here they are. First, you've got to look at companies as a sum of their parts. Second, always use forward estimates. Third, and we've already seen how critical this one is, use the right multiple. Fourth, adjust for things that aren't part of the core business. And finally, be incredibly careful about who you're comparing the company to. Let's break a few of these down.
Let's start with principle number 2. Always look forward. I mean, think about it. A company's value is based on what it's going to earn, not what it's earned in the past. Historical numbers can be a real mess, full of one-time events, or maybe results from a division they don't even own anymore. Forward estimates give us a much cleaner, more stable picture of what the market actually expects.
And this just illustrates the point perfectly. Take a look. On the left, you've got backward-looking multiples for some big pharma companies back in 2018. The range it's just wild. I mean, it goes from 9 all the way up to 72. It's almost meaningless. But now, look over to the right. When we use forward-looking estimates for 2023, bam, the multiples all snap together into this much tighter, much more logical group. All that noise just disappears, and you can actually see what's going on.
Okay, let's get into our third, and you could argue most important principle, choosing the right multiple. This brings us right back to our first example and the huge danger of just relying on a simple PE ratio.
So here's the crucial difference. A PE ratio, it kind of mashes a company's business performance together with its financing decisions. It's messy. Enterprise value multiples, on the other hand, they focus purely on the core business operations. They strip out all those distortions from debt and taxes, which lets you make a real apples-to-apples comparison between companies.
Look at this example. It's perfect. Companies A and B are identical twins when it comes to their actual business. They both make $100 million in earnings, but Company A has debt and Company B doesn't. And the result? Company A's PE is 12.5, while B's is 16.7. They look totally different, but look at their enterprise value to EBITDA multiple. It's exactly the same, 10. That's the real story.
Okay, so we've settled that enterprise value is a better number to have on top. But what about the bottom number, the E for earnings? We've got a few choices, right? Like EBIT, EBITDA, or EBITDA, which are all just different ways of measuring profit before things like interest and taxes. And believe me, the one you pick really matters.
This slide shows exactly why EBITDA is often a better choice than EBIT. So imagine Company C grew all on its own,
but Company A grew by buying Company B. Operationally, the combined A plus B is identical to C. But because of that acquisition, A plus B has to record this non-cash expense called amortization. It makes their EBIT look lower, which then artificially blows up their EV/EBIT multiple to 16, while Company C's is just 10. If you use EBITDA, it ignores that accounting quirk and correctly shows they are both worth 10 times. But, we can go even one level deeper. What happens if the companies you're comparing operate in different countries or just have totally different tax situations? This is where NOPAT, or net operating profit after tax, becomes your best friend. It adjusts for all those tax differences to give you the cleanest possible view of how the business is actually performing.
And check this out. It's a perfect example. We're looking at U.S. pipeline companies. Now, some of them are regular corporations that pay corporate tax. Others are what's called Master Limited Partnerships, or MLPs, which is a structure that doesn't pay corporate income tax. If you use EV/EBIT, their multiples are all over the map. But the moment you switch to EV/NOPAT, they snap right into this tight, consistent line. The underlying value is the same the whole time. You just needed the right lens to see it clearly.
So, we've picked the right multiple, we're feeling good. But even the absolute perfect metric is totally useless if you're comparing your company to the wrong group of peers. This brings us to our final and maybe most subtle principle. And this is a lot harder than it sounds. So often, people just grab a broad industry code, or worse, they trust the aspirational list of competitors a company puts in its own reports. But the biggest mistake of all is just averaging a group of companies without ever looking at how they actually perform. A real peer isn't just a company in the same industry. It's a company with similar fundamental value drivers. For example, take a look at these disguised oil and gas service companies. They're all in the same business, right? But you can clearly see they fall into 3 totally different performance groups based on their growth and their return on invested capital. So if you were trying to value the company called Swallow, would you just average all 9 of them together? Of course not. Its true peers are Owl and Robin, because they have a similar performance profile. And this leads us straight to the underlying math of it all. A company's multiple isn't just some random number. It's the direct result of a value driver formula. It is mathematically tied to 2 key things: its return on invested capital, or ROIC, and its future growth rate. It's simple. Companies with higher returns and higher growth will have and should have higher multiples. Which brings us to what might be the single most important takeaway from all of this. The source material puts it perfectly. Never, ever treat multiples as a shortcut. They need just as much careful thought as a full-blown discounted cash flow analysis, which, as you know, is one of the most detailed ways to value a company.
Because really, the goal isn't to just come up with a number. It's to understand the story that number is telling you. Why is this multiple so high? Why is that one so low? The multiple isn't the final answer. It's the start of a much deeper investigation into a company's real performance and its future prospects.
So, I'm going to leave you with this question. The next time you see a company's PE ratio in a headline, or in some analyst report, what's the very first question you're going to ask yourself? Because now you've got the framework to look right past that simple shortcut and find the real story.